Hi everyone. Today we're diving into something that might sound a little complicated, but trust me, it's super important for building your financial future. We're talking about life insurance. Isn't that just something you get so your family is covered if something happens to you? Yes, that's a huge part of it. What if I told you the right kind could also be a powerful tool for growing your wealth? It's not just a safety net, it can be a financial engine. Choosing the right policy is like picking the right pair of sneakers for a marathon. You wouldn't run 26.2 miles in basketball shoes, right? The same logic applies here. There are different types of life insurance designed for different goals. Some are straightforward, like term life, which covers you for a specific period. Whole life, index universal life. They offer lifelong coverage and a cash value component that can grow over time. Understanding the differences is the first step toward making a decision that benefits you and your loved ones for decades to come. Many people just sign up for the first policy someone recommends without really getting what's under the hood. Alright, let's demystify Index Universal Life, or IUL. The name sounds complex, but the concept is actually pretty cool and straightforward. An IUL is a type of permanent life insurance designed to cover you for your entire life as long as you pay the premiums. But here's the exciting part. It has a cash value component that doesn't just sit there. Instead of growing at a small fixed rate, its growth is tied to the performance of a stock market index, like the S&P 500. This gives your money the potential to grow much faster. Now, you might be thinking, does that mean I can lose my money if the market crashes? That's a great question. And it brings us to the most powerful feature of an IUL, the floor. Your policy comes with a guaranteed floor, typically 0%. Even if the S&P 500 drops 20%, your IUL cash value won't lose a dime. You're protected from market downturns. You get to participate in gains without suffering losses. It's a win-win safety feature. Of course, there has to be a trade-off. And there is. It's called a cap. The insurer sets a cap rate, the maximum interest your cash value can earn in a year. Example, cap equals 10%. Market return equals 15%. You get credited 10% growth. You might miss some massive gains, but you're completely shielded from the losses. The cap and floor system creates a balanced approach, solid growth potential with a built-in safety net. Now let's put these two policies head to head in a simple comparison. On one side, we have whole life insurance. Think of whole life as the tried and true steady player. It's been around forever and is very predictable. Your premiums are fixed for life. Your death benefit is guaranteed. This is a good time to remind you, if this breakdown helped, hit that like button and subscribe for more financial wisdom. We're all about breaking down these complex topics to help you win financially. Your cash value grows at a guaranteed modest rate. It's safe. It's reliable. And you know exactly what you're getting. There are no surprises. Comforting for people seeking stability. On the other side, we have the IUL. As we just discussed, the IUL brings a dynamic element to the table. Its cash value growth isn't fixed. It's linked to a market index. Let's use a simple example. Say you put $5,000 a year into your policy. With a whole life policy, your cash value might grow at 2 to 3% per year. It's slow but steady. With an IUL, if the S&P 500 has a good year and goes up 12%, and your cap is 10%, your cash value could grow by 10%. That's a huge difference. Your $5,000 contribution could see much more action. Let's look at a down year. Imagine the market drops by 15%. In the whole life policy, your cash value still grows by its guaranteed 2 to 3%. You're insulated from that market chaos. In the IUL, your 0% floor kicks in. You don't lose any money from the market drop, but you also don't gain anything that year. So in a bad year, whole life inches ahead with its small guaranteed gain. But over the long term, the up years for the IUL often outperform the steady growth of whole life, leading to a much larger cash value over time. So why might an IUL be the more competitive choice for many people, especially those with a longer time horizon? The primary reason really boils down to that growth potential we've been talking about. Over a period of 20 years, 30 years, even 40 years, the difference between earning an average of 3% in a whole life policy versus a potential average of 6 to 7% in an IUL can be, well, astronomical. We're talking about a difference that could mean hundreds of thousands of dollars in your cash value by the time you're ready to retire. That extra cash can be used to supplement your retirement income, tax-free. Let's think about it in real-life terms. Imagine two people, both 30 years old, putting the same amount of money into their policies. The person with the whole life policy will build a nice, respectable cash value that they can borrow against or use later in life. It's a solid plan. However, the person with the IUL has the potential to build a much larger nest egg. The compounding effect of those higher earning years, even with some zero gain years mixed in, can create a financial powerhouse. Another competitive advantage is the flexibility I mentioned earlier. Life isn't a straight line. You might start a business, have kids, or change careers. An IUL policy can adapt with you. Finally, let's talk about accessing your money. With both types of policies, you can take out loans against your cash value. And the best part is that these loans are typically tax-free. Because an IUL has the potential to accumulate cash value much faster, you may be able to access larger loan amounts sooner than you would with a whole life policy. This can be a game changer if you need capital for a major life event, like a down payment on a house or funding your child's college education. The ability to build wealth that you can access tax-free is one of the most powerful and often overlooked benefits of these policies. So, as we wrap this up, what's the final verdict? Is Index Universal Life the undisputed champion that crushes whole life every single time? Not necessarily. The right choice really depends on you, your age, your financial goals, your comfort level with risk. Whole life insurance is a fantastic tool for someone who prioritizes guarantees above all else. If you want to know with 100% certainty what your cash value will be in 20 years, and you don't want any connection to the market's ups and downs, then whole life is a solid, dependable choice. However, for many people, especially younger individuals who have decades for their money to grow, an IUL presents a compelling, competitive alternative. It offers a beautiful balance, the opportunity for market-linked growth that can significantly outperform whole life, combined with the peace of mind that comes from the 0% floor protecting you from losses. You get to participate in the good years without getting wiped out in the bad years. It's like having an airbag for your investment like growth. The key takeaway is this: don't just settle for the default option. Take the time to understand how these products work. An IUL's flexibility in premiums and its potential for higher, tax-advantaged growth make it an incredibly powerful tool for building wealth over the long term. It allows you to be a participant in market growth while sleeping soundly at night, knowing your principal is protected. It's a modern solution designed for someone who wants more from their life insurance than just a death benefit. They want a vehicle for financial freedom. Ultimately, the best move is to talk to a financial professional who can run the numbers for your specific situation. But now you're armed with the knowledge to ask the right questions. You understand the difference between fixed returns and index potential. You know about caps, floors, and flexibility. You're in the driver's seat. Whether you lean towards the steadfast reliability of whole life or the dynamic potential of an IUL, you're making an informed decision about your financial future. And that, my friends, is how you win the game. Peace.